Hello, good afternoon. Can you all hear us properly? Okay, perfect. So when we were arranging a little bit the topic for this, we have 1 hour to brief you everything that is going on in the investment market in Dubai and the UAE. So nobody better than Amr, I guess, is entitled to speak about it. First question would be just as an intro, could you give us a little bit what's happening in the landscape of the investment market globally and in the UAE?
How much time do you guys have? Globally it's a, it is still a big planet we're living in. Bismillah ar Rahim. Thank you very much, Giuliano, for this. Great to meet you all. So we started off the year in a very positive, optimistic outlook for what was going to happen. Compared to the past previous years, we've been a bit on a positive trajectory, transaction volume-wise, investor appetite-wise. We started to see many of the subdued investors who were a bit shy of hospitality come back in the landscape across the board, and then we'll try to maybe just give a bit of a micro approach in a few minutes. And all of a sudden, we discovered that we felt we were doing a lot more work, but for less transaction volume. So whilst we just published our year-to-date Q3 figures, this year we're at approximately $41 billion worth of hotel transaction volume across single asset portfolios globally. That's very much in line, almost dollar to dollar, compared to the same period last year. What we noticed is that some markets have been performing much better than others. So we're seeing a decline, high single-digit points in the US, whereas we're seeing a much steeper recovery in the European market. Asia is still relatively flat. So out of that $41 billion, I would say 17 to 18 is Europe, which is, by the way, if you look at historical figures, it was very tough for the European market to be at the same level as the US market. The liquidity within the Americas transaction business is usually far more substantial than the rest of the world. But we're seeing RevPARs lag a little bit. We're seeing the debt market is still relatively onerous. The equities are there. There's still dry powder for hotels. They like the sector. But, everybody's taking a bit of a cautious approach at the moment. There are some signs of positivism, some big transactions happening, some big trades, big box hotels in your key markets. But I think to compare to previous levels, there's a cautious approach. Legally, there's a few union-related regulations that are going to be coming to effect in September. Obviously, the impact of tariffs to your cost of goods, suppliers, things like that. So we'll see. Europe has been great, trading-wise, transaction volume-wise. Growth in France, growth in Germany, growth in Spain, really your key markets. The UK last year was really good, but because some of the big portfolios that traded last year, like the Radisson Edwardian, going to Starwood Capital, we didn't have those this year. It's still showing a bit of a decline. Micro-wise, Dubai has been on a phenomenal positive trajectory. Last year, we predicted that the transaction volume this year would top the $1.2 to $1.3 billion of hotel transaction volume. We're on track. I'm positive that some of the trades that are expected to complete before year end, that will put us on a good trajectory. Just to put that in perspective, London on a good year will do $1.5 billion, $2 billion a year. So for Dubai to be at that level, it's still faring as one of the top 10 most liquid markets in the world. Why is this good? Because irrespective of performance, irrespective of geopolitical signs, what this demonstrates is that there is liquidity. There is liquidity in that space. There is a buyer pool that's willing to penetrate the market, acquire, develop, rebrand, value add, turn around, whatever you name it, and exit. That's very important. This is the challenge that we were facing some 10 years ago when we work with institutional international capital. Fine, we know the hotels are doing good, but can I really exit? Can I really get my money back? Now, you kind of have an answer for that. That's the second year in a row where we should be more than $1 billion worth of deal volume. Next year, we'll see. Depends on what the pipeline has to show.
Yeah, I guess it's also driven by how much products you have in the market currently for sale. and how that activity arises. But if you think about it, Dubai is a great market. It has a fantastic track records for the last 7 to 8 years, especially after COVID. So there are lots of benefits in investing in the UAE and more specifically in Dubai that are very similar to other successful destinations where hotel investments happen almost on a everyday basis. So what do you think are the advantages of investing in Dubai or the UAE compared to other destinations in Middle East slash other parts of the world?
Listen, I think many questions that used to revolve around uncertainty have been answered. It's definitely a market that's heading at a very fast pace towards maturity, investment maturity, a certain level of sophistication that competes with your top 10 most mature markets globally. There is transparency around ownership laws, rules and regulations. There is transparency around labor regulations. You know exactly what the the managers, operators, brands, how do they structure their agreements compared to the rest of the world. And I think this is really what investors were looking for. And to top that off, trading. Performance has been great. You look at market wide, it's becoming a lot more fragmented. Some of the P&Ls are showing incredible signs on profitability per keys compared to international markets. And that's why we're seeing investors who are adopting really that private equity mindset being far braver than where they were before. You will see acquisitions at on buildings that are effectively just blank canvases, right? They'll come and buy the building, flag it. You'll take risk in refurbishment. You'll take risk in asset management. You'll take risk in turning things around. You'll take risk in stratifying your building and do some branded resi here and keep a little bit of the hotel there. That's really a very creative way to look at hospitality. On top of that, the freehold ownership laws, in my opinion, was one of the key catalysts because there's always that concern of when you enter a certain market that's culturally different than yours, what's going to happen to my land, what's going to happen to my building, God forbid, God forbid, God forbid. But the answer for that for us was just consistency across the board. And that's what Dubai has done really, really well over the last 5 years. It started with the residential sector, and that in my opinion, the residential sector, whether it's primary, secondary, branded residences, that's light years ahead of any major market globally at the moment. You look at the branded resi volume alone. Last year, we've done about $6 billion worth of branded resi sales. All of resi, $50 billion. And, the rules are simple. Whatever apply on your rental income, whatever apply on your capital gain taxes. I mean, there are some lawyers here actually in the audience. They're best placed to talk on this more than me. But the mere fact of you're providing that certainty and that comfort that you can exit, get your capital back, and able to recycle it elsewhere, that alone is one major catalyst. I mean, you look at this year, out of 12 trades that happen in hotels, in my opinion, 2 of them are local. The rest is FDI.
I mean, this is very good to know. And frankly, just to add on what you said, everybody speaks English in Dubai. It's common law. You can have the IFC as arbitration, which increase the credibility of every transactions in terms of litigation, in terms of any dispute. I was fascinated. Some of my friends from the Hotel Asset Management Association in the US, they call me, hey, what do you think about this hotel on the Palm? Like, you sit in Houston or in New York City. Why are you looking at the Palm? I says, well, it's like buying in the Caribbean for us, because the dirhams is has a fixed exchange with the US dollars. You guys speak English. The market is growing. Why we should not piggy bank on that growth and on that capital, which totally makes sense. But until 5 years ago, 6 years ago, that was a little bit of a very distant feeling. Now it's becoming more and more current. And also when you look at the participant of the conference, you see that people coming from the other side of the Atlantic are becoming more and more numerous. It means there is more interest, there is more traction on that. What I also like about Dubai and the UAE is that I think there is a product for everyone. You want to have a stabilized product, then you know you can get something on Sheikh Zayed, something in the IFC, something a product that is, you know, you don't have to work on it, but you can also have a buy and flip strategy. There is something for every ticket. Not everybody can afford the Palm. You can also buy another location. So in a way, Dubai, in terms of product, is also quite diversified for ticket and profile risk, which helps a lot for people to come in, but also to exit. And I super agree. If you buy, but then you need to hold to your asset because you cannot sell, then
Is
that's a
that your
reason.
case?
No, no, that's not our case. But at the end of the day, if you cannot sell, that's a problem. And if you need to sell, if you have a closed fund and your maturity is coming, then you don't want to undersell. The dream is always to sell it higher than the market price.
I mean, listen, look, I've done my days in brokerage. Some of you
They
have
are
done
not
as well.
finished yet.
I know, but it's just sometimes the perception of that word can be can scare people off. I like just to qualify it as loosening the strings a little bit, right? Uh, if you have a mandate to attract FDI, you gotta sell something. You know, my daughter's yay high, and she knows that already with her lemonade stand. But it's you only have two types of product. That's it. You got development, and you got existing assets. Development today is not like development 6, 7 years ago. It's far more expensive. It's far less accretive. It's riskier. The lending market, so it's something we need to talk about, by the way, with the banks. They look at development in a different, completely different manner than how they look at existing commercial real estate, right? So one way or another, that capital needs to go somewhere. Is there enough product for it to be allocated? If not, how long is that capital going to wait for until they look elsewhere, right?
Fully agree. And I think one of the underlying issue on value for development is the land. The value of the land has been increasing, and that means that acquiring land is more expensive,
So
building
is
hotel is more
construction.
expensive.
So
So
is
that it
construction.
means is contracting your markup and your profits.
So is construction cost. Even that that's been on an incredible hike spree the last 3 to 4 years. Um, Most of the contractors are really got their hands full, not just here but region wide. And if to put that in perspective, if I was building a cookie cutter 5-star urban hotel a few years ago, just after COVID, I would say 2021, 2022, say, I don't know, 250, $300,000 all in. That's a 550, $600,000 today. Maybe some of the investors who have special relationships with contractors or have that business, fine, they have a better privilege, they're in a better position than others. But Amr wants to come and adopt the traditional model of doing that. Uh, I gotta take a very long-term view. My multiples are different. My yield profile is different. My lending structures are going to be different. My capital stack is going to be completely different. I'm still going to find brands, which is great because brands are still super excited to grow their platform, their footprints here. We're seeing an incredible amount of third-party operators who can adopt, the management franchise model. I think I've seen the most really in this version of the summit this year, and the dry powder is there, but is it going to be as good as it used to be before? Is that going to be the new normal?
Well, it's a more mature market, and I guess also expectations on the investment are becoming more mature.
I mean, think of it this way: with everything going on geopolitically. No, no, let's face it. I mean, everybody's an advisor here. Ultimately, you underwrite at growth this year. Picture further stability, further upside, right? So I don't have the answer. I can't control the market. I can try and influence, but ultimately, I'm not going to be the one holding the capital, right?
True, I agree. But I think at the moment, if you look at markets, tourism market that are stable, that are growing, that are very high on everybody's agenda, I think Dubai is probably, if not in the first, is in the second position, but it's definitely in the top two. And that because it's attracting also, as you said, a very nice growth story. Summer for Dubai, which has been historically the low season, has been fantastic this summer. Uh,
Yeah, you guys have done
I
great,
was
by the way.
surprised. Yeah, I said,
Was
who
it
is coming
wholesale?
to
Was this
Dubai?
groups?
It was groups, but it was also retailers. It was extremely nice and mostly from Europe, UK. It's not just your Russian CIS. Indians made a big chunk of August travelers. So for that perspective, despite the 50 degrees, Dubai worked very well in the summer. Occupancy was well above 85% in the city. So if even a low season produces 85%, then it's not low season anymore. So find a market where you can invest and you have such a low season.
So we've become so spoiled that we just run away for the whole quarter, and the Europeans are coming. Brats that we are. Look, seasonality was never an issue, in my opinion, for capital, because you look at markets like the ski resort destinations, the Mediterranean coastal line destination, Ibiza, even in our part of the world, hey, Mecca, Medina. I mean, it literally does not get more seasonal than this. But because you know how to underwrite and you got so much data that can really just factor your risk premium downwards, upwards, and you can create a story around it, the capital's there. It might not be institutions, it might not be pensioners, pension funds, but private equities will take a view. Brands will take a view, you know. Uh, that's why you said there's a product for everyone, but there's also a product, depends on where we are in the cycle. It's just how is that capital going to be allocated, right? And we talk about Dubai, but you look at the rest of the UAE. So the buyers here completely different than your investors in Ras Al Khaimah or your developers in Abu Dhabi. It's 1 hour away.
It's
You,
completely different market, completely risk profiles, completely different appetite in terms of investments and on the returns. But everything is available, everything is under the sun, and everything is transparent now in terms of purchasing. And there is more transactions that fuel the exit. So for that perspective, it's never been more fertile grounds for foreign direct investment. I think one point that we haven't discussed so far is the financing. Which difference do you see in the financing between other parts of the world, US, Europe, and Dubai, Middle East? What are the major differences? Where do you think things could be done differently or better?
so differently, we started noticing that about 24 months ago. Sorry, 2 years ago, so it doesn't sound that far out. We started to see regional banks adopt actually the US model for income generating assets, which you see term sheets, 5 to 7 year facility, interest only for a couple years, and then very low percentage point on your amortization, and then you got to take a view at the end of that facility, or sorry, at the end of that term, you either refi with another bank or with the same bank or sell your asset. Whereas historically, we've seen those same facilities needed to be amortized, right, throughout the whole lifeline of the debt piece. So if you get again, let's go with the 7 year example, you would get a 20-30%, not to get too technical, 20-30% bullet repayment at the end. This means that your hotel needed to generate 8% of your investment every year just to service debt. And that's high. And that's why and now you can understand the long-term ownership, mindset. But the PEs don't have that. International capital, not all of it has that. Whereas now, it's because we're seeing more cash on cash, right? That the cap rates have compressed justifiably, and
Yeah,
at
I
least
mean,
at least it's a scientific reason behind it. Now, is that the right way? Is that the right thing right now, in where we are in the cycle? I would have preferred seeing that maybe 3-4 years time, because I'm seeing some of the global markets offering attractive returns than here now. So it's all right. Maybe I should go back to London then. Maybe I should fine go to Miami instead, right?
Yeah, I guess we are generalizing, we're saying Dubai or London, but if you would have invested in central London or in Singapore, a 3% yield was always considered like great,
Hold
great
on. No, no, no.
returns.
Hold on. Singapore, yes. London, no.
Okay, I agree.
London, we're at 7.
At,
London, we're
at
doing
the
7.
even central London.
Yeah.
Yeah. So
Paris, 5.5.
So, but then it means that certain areas of Dubai or the UAE, where the market is becoming more mature, where the assets are becoming more trophy, they are becoming closer to your Singaporean type of performance, while other areas still remain in your Paris performance or your London performance. So that repeats, there is a product for everyone.
Correct.
So, but everything is still fueled by this growth story. And I always say to everybody, nobody's allergic to additional profit. Everybody wants to make more
That's
money.
a good one.
That's a good one. Yeah, I
I'll
have
paraphrase
copyrighted it.
that.
I have copyrighted it. So, for that perspective, I guess there is entire Dubai machine that is helping in promoting also the destination, and the post-COVID was a very clear example of that. So, let's see. Let's do a sort of a case study, a sort of a real life scenario. Host hotels and resorts. I've identified Dubai that I want
Or
to
Archer.
or Archer, okay, and I want to buy some properties in there. The first thing you do, I'll give you a call, Amer. Says, Amer, help me identify the right products. What would you do? What would be your recommendation? Would you think at the different product profile that you would submit?
I mean, again, it's obviously we can talk forever around the different type of product, but a company like Host historically, they were Marriott's real estate fund basically. But let's say they want to look at a Marriott, right, urban product. I think it's if they identify a target, it's easy. I always say, guys, it's not rocket science. We're not sending people to the moon because there is so much data right now. If you are looking at a property in a certain submarket in the UAE, I can bet you 99%, subject to the right advisor, of course. You can get data on what your neighbors are doing. You can understand the ownership, freehold ownership. What are the implications of that? You can understand how the lending market is going to look at it. And if you have the possibility to brand, you can even have a sample of operators ready on standby, lock, stock, and just waiting to take it. And once you finish effectively your underwrite, similarly to any global markets, you're going to find all the best third-party advisors. You're going to find the right lawyers. There's an incredible amount of amazing lawyers present here, based here, who can advise you on your negotiations, on branding side, real estate side. You're going to find the right technical advisors, financial DD advisors. And guess what? It's easier because, corporate tax just kicked in last year. So it will be a less messy fiduciary due diligence to undertake compared to some of the other global markets that we look into. And obviously you build the story of FDI, but you want to do that in scale, right? A hotel here, a hotel there, sure. I mean, fine, whatever, great. I mean, the story goes on, and we go back to our normal days, but scale is key. Scale is really, really important. Portfolios being unlocked, global partnerships being unlocked, recycling capital into different parts of the city, different type of products. This is where I believe a market like this one should be at. So when you have a total key count of 180,000 keys, hotel rooms, that's more than London, that's more than Manhattan, that's more than Paris. So you do want to be ambitious enough to have a much bigger piece of the pie than some of your other international competitors.
Yeah, I think one of the differences between Dubai and the rest of the destinations we mentioned during these sessions is that in Dubai there is lots of ownership legacy, big groups with big amount of capital available. They don't need to sell properties. So for that perspective, they don't want to be seen selling properties, even if the profit would be very, very reasonable, just for a prestige type of things, and that probably prevents certain portfolios to come in. One of the point, and maybe that would be the other question, if there are one or two factors that is preventing foreign direct investment to come over, scales, we touched it. Is there any other factor that you think might prevent any group to look at this part of the world? That's a very good answer. So I guess probably only scale.
Again, I think we've done. It's just that we've done this long enough to know that downward trends. That's not really a preventative factor. Limited debt. That's not really a preventative factor. There is cap. The PEs are going to be waiting for if there's no debt. If things are on downward cycle, the PEs will love it. The brands are going to love it, right? So that's not going to stop investors from coming in. I mean, uh, it you gotta be bordering really force majeure provisions for to tell people, you know what, actually let's hold off, right? It's a challenge we see a lot. In some markets in Europe, without disclosing names, or in the U.S., we get a lot of complaints from union, organized labor regulations because that owner operator doesn't have control of. So actually, who does? You got to make sure you have the right relationships in the unions, for example. See my point? It's things that are
I'll
beyond
give a quick
your control
example. Maybe
day
you
to day.
cannot say, I'm very happy to say, but my friends of the New York Hotel Associations, they have two benchmarks for Manhattan, unionized hotel, non-unionized hotels, because the profitability is completely different, especially in the F&B department. So it's very difficult to be
Exactly.
profitable in
Yeah.
F&B in a unionized hotel, but that
Correct.
impacts your investment. Here we are
Correct.
lucky we don't have any of that. So for that perspective, from a US investors, they actually look at this like a sort of a mecca. It's brilliant. All the problems I have in Manhattan are not existing in Dubai. They would actually prefer to disinvest and reinvest in this part of the world.
100%. Listen, 100% of the entire workforce was back or working in Jan 2022. Asia, we still haven't even reached pre-COVID
My parents
levels.
were still at home in 2022, blocked.
So were mine. Trust me, lucky them. I should have done the same. But it was how swift that recovery was, and I think this is really what put Dubai on the map. Think about it. Performance is one element, but for an investor, it was the ease of the supply chain of events and the blueprint actually to be here, acquire something, own it, whether you live in it or not, and then carry out your business elsewhere, and you still know it functions and it does well, right? We, some of our clients here, they might have some struggles in Australia, for example, right? You got the time barrier, you got all of the distance, or in California, or. But it's not something European capital will complain of if they're here. It's not something Asian capital will complain of if they're here, right? I'm not trying to promote Dubai. All I'm saying is ultimately these are recipes and factors of success. So I just wrapped up a 2-week roadshow with my global colleagues, and we're meeting some of our friends, and they're interested in always finding out where my colleagues are from. And I think it's the first time in my entire career where my colleague based in London had more misery than I was. Oh, you're from London? I'm sorry. Okay. Perception. But guess what? Trading in London is still phenomenal. Investors still want to go there. Yes, there are certain incidents. Yes, safety can be an issue. Yes, taxation is an issue. But because you have so much data that goes far beyond, and you kind of start underwriting where's that downward cycle going to end, and maybe a new political system is going to be placed in a few years' time, and then things are going to take an upward trajectory. You're like, sure, why not? If I'm getting the right yield profile, why not? Right? So it there comes a point where it your bottleneck is limited to one or two things. That's it.
Yeah, I mean, and if one of the points of the bottleneck is force majeure, that really applies everywhere in the world. So, for that perspective, that doesn't really set you apart. If there's something really unique, I would say almost magical about the Dubai market specifically, is that it has not been regulated. In Abu Dhabi, they blocked constructions of new hotels to make the existing hotels more profitable. Now they're just reopening it. That didn't happen in Dubai. In Dubai was free market. Hotels were opening every second week and the market was still growing. So that proved that with the right support of marketing, destination marketing, events, then there is enough cake for everyone, and actually everybody's benefiting it more. So I guess part of that growth story, part of that machine, is very difficult. I've not seen that replicated in many destinations around the world. You can literally pinpoint them on the map, but those destinations have attracted lots of capital because once there is a very clear direction from government down to the hotel, then if they are betting their money, I can also bet my money in it. There is also that increase of trust, which is more of a qualitative perception basis rather than just data. Yeah.
No, you're definitely taking the right bet if you're a long-term holder, definitely. But a lot of the capital that we're seeing is short-term, 4 or 5 years. So maybe at master plan level, at infrastructure level, it's not the right time for them. But in certain submarkets that are scarce, development moratorium, can build, uh, existing management agreements coming to expiry, yeah, right. So call it you did the downtowns of the world or the waterfronts. To your point, the expansion of the city, you never know where Tier 1's going to look like in 5 years' time. So it took Berlin 30 years to get their new terminal up and running. You and I were going to a tube station every year just to attend the investment conference. London, they're still debating about the third runway, right? So if you have a new airport and doubling in capacity 5 or 6 years time, the impact of that is unbelievable. Not just in hospitality, but think about it. The amount of people working there are going to live there, residential, healthcare, education. Expo is a fraction of what we're talking about here, right? And then, whilst the rest is still functioning, the rest of your sub-markets are still functioning, stable, and growing, right? But then this is the new wave of master plan capital. And then it starts moving into ownership capital, right? And the origination of those two are completely different from one another.
No, just also to add on it, it's also a question for the audience. I cannot recall many destinations in the world where you have two Four Seasons, two Ritz-Carltons, two St. Regis, two Mandarin Oriental.
All owned by you.
Yeah, oh, also.
All owned by you.
Somebody got to do it. But at the same time, there are not many destinations around the world that can have that caliber of hotel, two of everyone. And now with Palm Jebel Ali, why not three of each? So, and they're all profitable and they're all successful. So, from that perspective, I don't think there are many in the world. Paris doesn't have that caliber. Maybe London, but again, I repeat, there's not so many, and that proves that even with the expansions of the city, you still have a growth story. A little bit more risky if you were taking a development side, but there is still a growth story at every single point of the life cycle and a different geography. Now, my favorite questions. You must receive thousands of phone calls every day of people that want to invest in Dubai. Hundreds, okay, hundreds. So give us your top three in terms of locations in either cities in the UAE or specific locations in the UAE. Is everybody attracted by Palm, by the IFC? Do they want to have a value add and therefore a more secondary location? What is your most frequently asked question?
Look, it does always start with what's the product that's available. But then it trickles down to what is the risk you're willing to take. So branding risk across the city right now. Yeah. Until Emirates Road, it's everything north. owner operators, funds that work with brands or have or can venture in that space. PEs, uh, mid-scale, upscale in portfolios or value add story. High nets, core. Your Palm Jumeirahs, your downtown,
Your Sheikh Zayed Road.
to an extent, because it's still new on freehold wise, right?
The new section of Sheikh
Correct,
Zayed. Yeah.
correct. That's correct. But core, high net worth individuals, business bay, for sure, as well. Front row, so not behind the canal. Yeah, but it.
And you
there's
receive
a lot of dry
inquiries
powder.
for location with a higher development potential, Ras Al Khaimah, Abu Dhabi.
If there's branded resi, if there's a branded residences angle, for sure. What we haven't seen yet, and that's more related on the financing, we haven't seen the. We've seen some credit funds, but they want to do that with partners. And the last 3 to 4 years, if you look at what's been happening in the US, for example, the credit funds were actually becoming much more commercial than traditional lenders. So if you look at where the SOFR was, I think last year we had reached close to 8.5, 9% cost of debt, all in. Right, a credit fund, you tap into it, can offer you something a couple of 100 basis points lower than that, right? Until the debt market normalizes. We haven't seen that part today here yet. It's still regional lending dominated. Though we did complete an acquisition with actually a local investor, but has partnered with a major credit fund on this. They believe in the Dubai story. They're willing to take risk and convert that expensive debt potentially into common equity over the years.
That's a very interesting way to look at it. I think one point, which is a sort of a subsection of what we discussed, is that at least from my perspective, I still receive phone call from my old clients when I was on the consulting side of operators that they want to expand in Dubai. It's difficult for them to enter with a HMA for the first time. So they're looking at buying a property to put a flag and then use that as a sort of a showcase. Has this happened to you as well? Have you seen operators that at the moment want to enter the scene and the only way to have it is to put their own stack of equity and purchase a property?
Every day. Every single day. Seriously, I'm not exaggerating. The issue is how much skin in the game you're willing to offer. It is so competitive at the moment. It kind of reminds me before the GFC, where if you wanted to secure something, you need to put at least in Europe, right? You just pay the landlord's rent and you're good to go. Or you strike a variable lease contract with some minimum guarantees. We're seeing that today in Dubai. We're not seeing it in other parts in the region, unless it's a rebrand or depends on the hotel if it's iconic enough. But for existing product being rebranded, we've seen development loans from hotel operators. 100%.
That's very interesting. Then it means that there is a double growth potential. There is the destination that in terms of numbers, in terms of profitability is becoming higher, but also for brands. Once you are in Dubai, out of a sudden you are one of the big boys.
Correct.
So you're in Dubai, people will give you more hotel, you're signing more HMA, not just in Dubai, but also in the region.
Correct.
And therefore having a showroom in Dubai opens the door for other management agreement.
Correct.
So that's, I always tell my friends, it's like the Dubai chocolate. Chocolate has been in the market for thousands of years. Guess what? Dubai has reinvented chocolate. Now we branded Dubai chocolate. Is a new wave of success. It's the same. You can have your own brand, put it in Dubai, and out of a sudden becomes Dubai brand, and it's a new life.
And you can roll it out. And even there's a lot of homegrown brand that expand internationally. I mean, I don't know if the Sunset Hospitality guys have they're here, what everything they're doing in the F&B space or in the hospitality space. Kudos to them. We did something with them in Asia Pacific, and they have an aggressive plan for Europe. They already signed a few things, and it's the vice versa model works well too.
This is, I guess, it's a very nice summary. Is there anything before we move to question and answers? Is there anything that you want to tell the audience? What would be your top 5 recommendations if anybody in this room wants to invest in Dubai? First of all, takes his number, and then second, is there any top 5 points that you want to make clear? Everybody takes away.
Work with JLL, work with JLL, work with JLL, work with JLL. No. Listen, I mean, you really need to build your story. You got to know exactly what you're looking for. You want to make sure you're surrounded by the right partners. And you got to be patient. It's a tough word. I don't have a fifth. Patience is key at the moment.
I mean, closing a deal requires lots of patience because you never know what the negotiation will
I don't
entail.
know what I'm doing
And
in hotels. I should have been selling houses, I swear.
that is the same everywhere in the world. I guess lots of people have been there, either both sides of the table, but that is inevitable. But you know that there is a commitment. There's no once you're gonna go in the story of purchasing an hotel in Dubai, you know that the growth is very solid. So it's not just it's just a story. The numbers are very much supporting it. So we want to open the floor. They recommended me to give at least 10 minutes for question and answers.
At
So is
least
there
10
any
minutes?
at least 10 minutes?
Okay.
I think we have that.
Yeah.
Is there any specific questions from anybody in the audience? Oh, that was good. It
Yeah,
means
we're done. Let's go.
has
Hear some
everybody
Albanian
prepared the
music.
wallet and purchased properties?
Hi.
Hi.
Thanks for that. Very, very interesting. I just came back from a trip in Asia where, of course, you have quite developed public markets as well, REITs, listed companies. What's your view on that for the Middle East and UAE in particular?
Listen, they've gained substantial popularity in the residential sector. In hospitality, it only works in 2 places, Singapore and the Americas. That's it. It becomes private REITs are more popular than listed REITs. We see with private REITs much better control from the management, much better flexibility and understanding from the owners of those REITs towards the people who run them, because they can understand the implications of big capex amounts. They can understand the implications of certain delays. They can understand implications of a downward tourism cycle. Whereas in listed REITs, you see tremendous pressure on share prices that in many occasions, in fact, in most occasions, have nothing to do with the fundamentals of the hotels they own. So in 2021, all of the capital, outbound capital, was going to listed REITs in the US. You buy shares for cents to the dollar on assets that's worth $1. Why should I buy the real estate? I'm just going to buy parts of the company that own them. They tanked. And that's when we started to see new regulations. You cannot do more than 25%, blah, 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 blah. That sort of implication and pressure is not the sort of thing you want to have with the stakeholders who own hotels. We see a lot of much more traction, like I said earlier, on residential REIT. That makes sense in the multifamily space. But on hotels, if you want to do a listed REIT, you got to have a substantial portfolio. I mean, you got to have a mix of trophies, iconic, select service, across the board. It's got to be big, really big. You're going to get liquidity for it, but the people who exit, you still have to leave certain ownership, asset management, regulatory governance there. You can't just walk away from it.
Yeah. And you know, in this part of the world, the residential regulations is fantastic. You pay upfront, you pay in checks, in post-dated checks. So even if the tenant disappears, you still have the checks available. So it's literally a rent roll. So everything that is residential or retail works very well, is very predictable, is very stable. So that attract a risk profile which is very low and very retail, I would say, in terms of approach. With all the hotels under a management agreement and some of them under a franchise and a management agreement, as Amer said, you better have a very good proportion of your REIT based on sort of a stable income on iconic properties where the potential is seen as untouchable, and that would attract some part of that retail story. Otherwise, you're only attracting specific hotel investors, and there are in this part of the world, but not on a fragmented basis. You know, if there is a very specialized hotel investor, they will probably go for the full asset, so they would not see the benefits of buying a portion in a REIT. It is becoming a little bit more technical, but very happy to take any other questions.
Thank you. Amr, can you maybe talk about briefcase deals? So like greenfield briefcase deals under land parcels. Obviously, probably more regional interest potentially. I don't know. Can you maybe talk about that? Is there any activity in that space?
Not as much as before. So in Saudi Arabia, it's still a very popular model. Many of the landowners have held on those lands, family legacy, as you rightfully called it. In the UAE, not so much. In most of the cases, we see that landowners are eventually the ones developing their hotels. They might get some sliver equity here and there, whether it's from white label, whether it's from certain specialized brands, not the powerhouses, because they don't do any equity exposure. But most of the capital stack is still by the landlord himself. You might see JV deals, but those are usually strategic and carefully curated, not common. But they will happen. Be on the lookout. They will happen. We know of a few going on.
I mean, my feeling is that purchasing the land and building an hotel are two completely different business. At least in this part of the world, they are really seen as different business. There's people that bought the land when Palm Jumeirah or Palm Jebel Ali is being built because they want to secure the space, but they are not yet convinced. They don't know what they want to build on it. Then they realize that they can build an hotel and they have no hotel experience. So that would definitely convert into a JV with somebody that has the hotel experience. Otherwise, it's the recipe for disaster. And I think we will see more of those JV structures because some of the lands that are in very beautiful locations is owned by people that don't understand hospitality. And I think like all the palaces on Jumeirah, those probably will naturally be reconverted into hotel, for example. So
There you have it.
so I guess that's probably what's going to happen. Yeah. More questions. All right. Well, we're still going to be available when the lights are going to turn off. So thank you very much for attending, and you can come and ask directly to us anytime. Thank you so much.